My name is Nadine Filko, and today we are going to talk about how to get to the money. More precise, Deal Makers 2025 pitch and path to your next investment. And I'm really happy to have here Christine Tabak-Forstinger. She is co-founder and CEO of She Impact Capital. Welcome, Christine.
Hello, Nadine. Good evening. Very nice to see you again.
Great to have you here. Can you maybe jump in and in the first row, tell us, how did you actually get to She Impact Capital? What drove your interest in impact investing? How did you get there?
How did I get there? I think this was via a small detour via Africa. But if you ask me, Nadine, I'm going to tell the whole story. It might take a minute, but I try to be short. I come from the traditional financial world, have a traditional financial background, and was working at a private bank here in Zurich. We structured funds for wealthy families. And in 2008, which was the time of the financial crisis, I co-founded just by accident. But, you know, in life, there are basically no accidents or no Zufälle, as we say in German. So everything, I think, has a reason. I co-founded a project in North Ghana, in West Africa. And I think that changed my life forever for the better. Because when I came back from my first trip to Ghana in 2008, this was really all privately, and I'm still very much involved in that private project. And it started off with nothing, and now we have become a really successful project. But when I came back, my boss said, Christine, we have that weird request from a family office. They want to structure to their fund also, so next to a financial return, a social and environmental return. So you come back from Africa, you look into this, right? And this landed on my desk. And I loved the connection, you know, between financial return and environmental and social impact from the first minute. And I thought, okay, now this all makes sense to me. And a fire was ignited, and I never left the space. So there were then further steps until I co-founded She Impact Capital in 2017, but always then since 2008 on basically the sustainable investing and impact investing track. Yeah, so my small detour via Ghana.
And what companies are you focusing on? Where is the impact you want to support?
Yes. She Impact Capital, our current firm, is a fully independent impact VC investor. We are not investing in Africa. So this, you asked me about my private story, so I happily shared it. But we are investing actually in Africa. We are backing European impact tech pioneers, also circularity tech pioneers that provide solutions for the most burning issues of our time in the climate tech space, in the food tech space. Today we're going to speak a lot about food systems transformation, but also in the new, in the smart materials space, like in the built environment, because there we see a very strong leverage towards accelerating the shift to a regenerative and circular economy. This is where we invest in Europe with a focus on the DACH region, backing those pioneers with a long-term view as an impact investor. And for our investors, we want to, combine both real, as we call it, deep impact, but also strong financial returns.
Now, when talking about impact investing, for founders, it's always difficult to get the money, right?
Yeah.
And at some point, they need to show, okay, we've sold that and that. Oh, hi, Alex.
Hello.
Nice to have you here as well. I hope you're fine with us. We just jumped into our discussion as you didn't join before. Welcome, Alex Chandrowski. I hope I pronounced your name right. You're the host of Investment Climate Podcast and also Investor Relations Specialist at Ayana Bio. I was just about to ask Christine how difficult it actually is for impact investing, as the companies need to show we're making the money, and in impact investing it's even more difficult because the tech is not that well developed, and they maybe have other goals than making money. But before we deep dive, maybe Alex, can you tell us a bit more about your background and how you are connected, and how did you jump into the space of investing, and also how you came up with the idea of your podcast?
Yeah, absolutely. And thank you so much for having me on. I'm actually currently in the Netherlands in meetings for fundraising purposes for Ayana Bio. So I'm and the internet went down in the building I was in. So that is the life of fundraising right there. So that little experience you get up close and personal. And not to talk too much about my background, because it's quite different, I think, than most people's backgrounds. I don't have a technical background. In fact, actually, instead of going to college at 18, I spent 5 years in ashram, so a Jewish ashram. So and then that led me to actually eventually building a food company, becoming an advisor to IndieBio, which was the leader in biotech innovation in San Francisco, where I lived. And then years later, I got a chance to basically focus on the one problem I thought we could solve for startups, which is a unique advisory service for fundraising that did quite well. In a year and a half, we helped companies raise over $20 million. And my love is in building companies. So right now, the decision I made was to join companies full time as a member of the team to help them fundraise in their journey. And I think that is what I want to share with the listeners or whoever is involved in fundraising. This is a job. This is a full-time job, and we have to treat it that way. And often when we are thinking about fundraising, it's an afterthought. It's an afterthought that comes after, let's recruit the right people, let's make sure that we have the right scientific solutions, let's make sure that we have the right type of milestones of how we're going to achieve that. Fundraising in today's environment should be seen as a headcount. If it's the CEO's job, then they should understand that there's a full-time job of the CEO to succeed in this role.
So I could not agree more, Alex.
And this applies for companies that have great prospects, because they're all about making money. So maybe you both want to jump in for how do we do it in impact investing? That makes it even more difficult. And also maybe food tech, because somehow food tech always has this impact investment character, I'd say.
Alex, do you want to start?
Oh, Christine, I would love to learn from you. So I'd love for you to start, and then I'm sure maybe there's something small I can add to what you say.
Yeah, absolutely. Happy to start. I think it depends, Nadine, what we actually mean, by impact investing. So there are different approaches, different angles. For us, I'm speaking from the view and the perspective of an impact VC investor. We have a very clear mandate to create strong financial returns next to a real deep measurable impact. Thus, for us, there is no trade-off, between impact and growth potential of a company. Always, of course, we want to see that the company has the impact ingrained in the core business model, that the company solves root cause problems, but still, has strong regenerative, growth potential, because we also are obliged to create strong returns. Always, however, and that's important, with the view of an impact investor, which means, for example, that you really try to secure, for example, inside letters to the share purchase agreement, that you want to always guide the company towards a responsible exit. And for example, we support our portfolio companies not only on the whole measurement and management side of impact, but also really helping them to become, companies that really drive systemic change in their sectors. And also, or maybe I'll leave it with that. Maybe Alex, do you want to add a couple of thoughts to that?
Absolutely, and I think that these impact funds, of course, have this triple bottom line or double bottom line in the decision making they make. But ultimately, an impact fund has to return assets, and not only just return the investment, but they have to return in a way that is profitable to the LPs, right?
Exactly.
Now there are there's different type of impact investors where the LP is looking at the investment through different eyes, right? And this
Exactly.
may be something to discuss later, where their measurement of success is not in returns of funds, but in job creation.
Yes.
So this will be, for example,
social impact side of things. Exactly, when you go, for example, for a development impact bond or whatever. So there are different types of products. This is also what I meant.
So I would just highlight is it's very important in today's environment to understand what is the mandate of the LP. If the LP's mandate is to create jobs, and you're creating jobs, you know, one can look through they're almost, the idea of profitability and return of assets is secondary to job creation, right? So, and that could be, that's why we see a lot of funding moving from regional investors that are government backed, and it's very popular in Europe, right, where you are very generous form of investment, but the generosity comes not from the expectation necessarily of returns to the same level as a traditional VC, but returns in job creation or to the ecosystem. And this is kind of where I see it. The VC market is built on a power law, and anybody who's in thinking about setting up a startup, they need to understand what the power law is, which is you are looking at one or two winners across a portfolio of 10, right? And not only looking at a winner, you're looking for an outsized winner of disproportional returns. Disproportional returns only happen when you have software or pharma-like margins. What that means is that a software margin typically is seen as a 75% to 80% margin. That's not margins you see in food or agri-food. It's a very challenging. So to put a VC model onto food, I think has been a struggle, because the margin existent in food is different than that of a software place. So when you see an Oakley that just got bought, they got 3x top line revenue. So that's $500 million of revenue times 3 times, which was $1.5 billion purchase. That's a 3x top line revenue. Software purchases can go from 10 to 25 times X top line revenue at times, right? I can share crazy stories about that. But the point I'm trying to bring is, if you're looking to build a business today for investment of VC, then you need to understand the software business and model your margins after that. If you're looking for a CPG margin style, then you're looking more at private equity, and that's a 3x times top line revenue.
So if I understand right, in the food area where the margins aren't that high, I don't even have to try? Or is there any other secret how I can do it? Or are people or investors maybe also changing how they invest? I mean, what does that mean for people out there seeking investment?
Christine, do you wanna take that one, and I'll and I'm happy to give my perspective on that question and how.
Yeah. And maybe Nadine, maybe I can quickly add to what Alex has shared from his experience. I think it's still important to distinguish between a traditional VC investor and an impact VC investor, right? For example, we don't have that spray and pray approach. We also don't bet like only on whatever one winner, but we back companies where we believe in from the get-go. Yeah, and we are a long-term investor in those companies. Having said that, we also want to see a strong exit in those companies. I think that's a very clear differentiation point between a traditional VC. But I think what is, where is an overlap is that today, definitely in the VC space, impact VC, strong impact and strong financial returns go hand in hand. On the food side, I mean, we have invested in food tech companies also in the wider food tech space, for example, the packaging space. So we, of course, it's not comparable like with whatever a SaaS business, but usually those companies for example, where we invest also have a strong tech component involved. So they also show a strong growth potential. And of course, not those probably outside SaaS returns, but you would also not expect it. Yeah. Alex,
so is that maybe already one point, that if you have a company where you don't have like margins up to the whatever, that you approach certain investors, that you have to take a look at what they're, you always have to take a look on what they're focusing, but maybe, and that's a question I have in general, it's not only about the company, but it's also about building relationships and having more than just your product.
So I'll add in terms of like I obviously have not I'm bullish on the sector, otherwise I'd go and sell software like I did in 2020 and I was very comfortable. I love the sector and I believe in it tremendously, right? My job is not to do a podcast, it's to raise money. If I don't do that, I get fired. So definitely, I'm quite bullish. I have 3 kids and a wife, so I have to be bullish. Otherwise, I think I'd have to explain to my wife why I'm away a week out of the month if that's not gonna happen. But I do believe in certain principles today, which is number one is that VCs are not meant to be putting money into steel. That's not what they want to do. Okay, and this is a common theme, which is typically a VC cash should go into fundamental R&D and commercialization. If you can take out the necessity to build a factory out of that process, it's a very important process to consider. So if you're choosing a tech to work on, and your tech requires your own factory rather than existing infrastructure, you should strongly reconsider your business model immediately. The second thing is you need to consider if you are where you're regionally based. Okay, if you're regionally based in Europe, for example, then you need to understand what is the ecosystem of your local investors there, and what is the drivers of that investment. Because again, there's tremendous amount of funding that's available right now to promote sustainable innovation that creates local job opportunities, right? And if your business achieves that, even though it might not have software margins, it can get that level of investment. It has to be a sound business, but it has to create jobs. And again, and the third thing is that I'll say, like, why I am still I'll say one last thing though. If you're a software business, you have to. Think like this. You basically had funds get set up in 2020, 2019, 2018, new funds, 2021. Right now, there's no new funds coming online, so there's no new cash, typically, right? So what that means is that the fund money that's found is towards the end of the vintage of that fund. So if a fund is 7 years, they have a 7-year investment period and a 3-year hold, they're going to have to give money back in 10 years. What that means is if you're in year 5 or 6, that means they have to give your money they invested now in 4 years. Therefore, you'll see more and more VCs currently in agri-food tech investing in software. And that's exactly what you see. Or closer to maturation of exit. So when I've said the focus on revenue and more investment in CPG rather than deep tech is coming from the fact that the cash that's still left is towards the end of the vintage and needs to be given back in 3 to 4 years. So if you're starting a company whose exit is due to be in 7 to 10 years, you're in big trouble. You're not gonna get very little money, very little chance you're gonna raise money. Sorry to be so straight.
Would you agree? Is that just it?
But that's an interesting point of view. I mean, what I would love to add quickly to the discussion is on your previous point, Nadine. So does it make sense also for a founder basically to look, at the larger stakeholder map, and I would say yes, this makes very much sense because when you really wanna build a sound company that is really on a substantial growth track, that really is on a mission to accelerate the shift towards a regenerative and circular economy, in particular in the food space, then you should also look how can you what is your real potential also as a company to drive systemic change. So, for example, we have collaborated we do this with our investee companies, but just recently, for example, have done a systems mapping, basically a larger stakeholder analysis and a systems mapping for this company, together with this company. So basically, we were in the driver's seat together also with an external systems change partner, a scientific partner. And why did we do this? Because we wanted to check out, where are those leverage points that about the company did not think of before, and where are those leverage points, and that can be very helpful in driving real systemic change and also accelerating the growth path of such a company in a regenerative way.
But this
that may sound a bit theoretical, but actually, so we have done it for one of our portfolio companies, and this was very, very hands-on, very practical, with real recommendations what to do in real life for those founders. I think this is actually very helpful. Because you raised that question, so I came up with that answer.
Yeah, no, thank you very much. Actually, you both are confusing me a bit, I admit, because when we're talking about food tech, we're talking really about long-term development. Yes. We're talking about technology. If I only look at precision fermentation, cultivated meat, stuff like that, this really needs so much more research. There's not going to be big returns, and there's no small software, whatever. Maybe somebody's working on some software for fermenters so they can, I don't know what, do what. But so how do we get there then with these companies? Is there actually a chance for, especially in the EU? Because if I believe you, Alex, I think we're already done in the EU then. But not for the companies who maybe are going to different markets, but for the EU market. So how do they get there? What are your tips now for those companies founded now, and who are seeking money for these long-term developments? Is that only governments and associations there then to jump in, or how does that work? Hope you can help me with my confusion.
I'll start. Should I start this one first?
Please, Alex.
So my recommendation is, and this is coming from conversations with the researchers who have recently spun out companies, right? What we see is an interesting pattern. The longer you can stay in academia, the better. And what I mean by that is, if you have a pathway of staying in academia, and academia will pay for your research, and then you can have ownership of your research. Like, for example, in Sweden, that's a great, safe place to be. Stay in the university, bake your idea, use as much leverage and get government funding to pay your salary. But understand that you got to try to commercialize your research. That's a very smart, some of my guests have done that. And I think that's a really interesting. And Sweden is a really good example of that, a country that allows for that. AKA, a researcher gets funding to do work on his project, and then he's incubating that project. And then that project is then goes and actually, when it's ready, is owned by the researcher. And then he can go at a more mature stage, raise the higher valuation. So that's if you're a scientific founder, that's what I would tell you to really consider. Stay in academia as long as you can and get as much government funding as possible to do your research. And then when you're ready, make sure that you can have a licensing agreement on that research, that you can own it, or you can take it and commercialize it, because there's a tremendous amount of research done in universities that, because of the way that the university is set up, is failing to be commercialized, right? So if you're a PhD student now and you want to do some sort of research, make sure you already have in mind how you're going to take that research out of the university. That's a very key strategy for you to do. But get as much government funding through your university learning as possible.
I think this is a very valuable recommendation. Also, to get non-dilutive funding from the very get-go. We, for example, in our mandate, we don't invest we don't do angel investments, very early stage, but we only invest in companies Series A and up. So going back to your question, Nadine, I think the whole bio-based economy, the cell X space is still a very, very promising space. I think we urgently need that shift in many different areas, many different, whatever, not only in the meat space. And there, indeed, as you said, right, there is a lot of R&D money required, a lot of kind of patient capital until those companies really get to their first revenues. But I think, in that stage, also a lot of like-minded private investors are out there to back those founders on the next, basically, level of growth.
How would I start? Now I'm doing really the basics. How would I start? Now I'm in a university. I've got this great idea. I'm doing my research. I'm backed by the university. I have the money. I have the patent. And now I'm going out there. Where do I actually start? How do I just do my research? Investors in. Is there any spot I can go to get started the right way? And what do I have to bring also? Is there certain rules? Are there certain rules for people seeking investment? What they definitely need? I mean, Alex, you said it's a job, a full-time job. So how do I get started? What do I also need?
Well, so let's assume that let's take the individual who's a PhD in the university, right? So every university has a commercialization director. His whole job is to commercialize the research in the university. He's paid to basically do BD for you. He's a free employee of yours. Assume your research is good, you can go to him and say, look, I think I have something here. Can we start having conversations with the local ecosystem from the corporate and the corporate and early stage investors for me to get some feedback from them around, is this a valuable solution for them, or co-design the solution with them, or for example, the corporate might sponsor somebody in your lab to be able to support you, right? So first of all, I tell individuals, and I've seen this again from the guests on my podcast, they've done this very well, is that they go to the university, they understand what are the resources my university has in terms of spinning out commercialization. Companies like universities like Stanford are experts in that. The university in Belgium, it's going to come back to me. The name of the university is going to come back to me. Just interviewed them like 2 weeks ago. So there are some universities that are experts in commercialization, and that's the first address you need to be able to go to. And number two is you need to be very, very clear. Who owns this research? Who owns this? Because that is a fundamental question. If the university owns it, how do we actually take it out of the university and become an asset of you as an entrepreneur? If there's no clear answer, then there is no deal.
Christine, is there something such as a click moment, this momentum you have when somebody's pitching, and how do they, make sure that you, out of the 100,000 pitches you get every week, I don't have an idea how many, how do they make sure you read it?
Of course, we always do like a quick screening if the company does fall under our investment strategy. But if we believe, there is the first quick cross check, is a fit. Then we of course look at the deck, and does the deck, is the deck convincing? Is the deck, does it need a speaker, or do we get the message? Do we understand the message? Do we actually know what they are selling? Do we understand it? And in a clear language. So I think it should not at all underestimated, how you pitch the first idea. I also think it's extremely important when I think our audience today are like relatively early stage companies. So I think it's also very important to really take the time to address, the pitch to one of the team members, to really approach the team, but not just send out a standard email. Honestly, we do not read those emails. If somebody does not take the time to kind of personalize it, we do not even look at it. because we don't want to work with such founders. Yeah, really. Yeah, because we it's also like a marriage. We want to also get the grit. We want to get the vibe of those founders. We just really want to work shoulder on shoulder with those ladies or those guys in the long run.
Alex, is that your experience as well? Is there something such as a spark that people tell you about, or what's it about?
Yeah, so I have interviewed at this point, I think almost 40 founders who've raised in the last 6 months, meaning not in 2021. So every founder, I only interview founders who raised over the last 6 months, and only in agri-food tech, right? So that's my niche. So, and I asked every single one of them, how did you meet your investor? That's one of the top questions I ask. How did you meet your lead investor? Because I'm always very curious about how that happens. And the answer was very painful to me to hear. Why? Because my background is selling software, and I did what's called business development through effective cold outreach, right? That was one of the tools I used in selling. It's a standard methodology of selling software. Every single one, without exception, not one of the founders who raised money and through investment did it through cold outreach. Zero. Everybody had a warm intro. That's a pretty strong data set. So I would just add to what Kristen is saying is, if you want to even get in the league of having a conversation, there has to be someone who forwards your email and a blurb to that person. And I think it's set up specifically that way. And again, it may change in the next 6 months with the way that things are evolving in AI agents. It may change that. We don't know. But right now, at the moment, one of the barriers that VCs have put up is that they expect the founder to come through someone in their network that they trust. If you don't come through that, so far we're talking about 0% chance of raising money through cold outreach, especially if you're in a Series A or seed. If you're pre-seed, maybe, but otherwise you have a statistic percentage of 0.
So it all goes back to the marriage, actually. Is there any impressive story you can think of out of these 40 where you thought like, wow, that I didn't hear that before yet? Like something you can give our listeners as advice, or yeah.
Yeah, I mean, look, I've heard just the most incredible ways of how they did it. One of the founders I interviewed just recently, they raised a $20 million round. That in the next 3 months, they did an AI technology software on the greenhouse management of Canada, and he was introduced. He was basically introduced to his lead investor through the ex-CEO of Whole Foods, who was introduced to him by his investor. It was Joe Montana, who's a famous, football player with not soccer, football, I guess. Yeah. So, and he built that relationship with that CEO of Whole Foods enough to be trusted. And he said the way that he really built it was they went to a hotel to meet an investor. They went to a hotel and they were going to pay for their rooms. And the CEO, there was essentially a cost, the agreement that no employee of the company was going to purchase a hotel room above a certain amount, let's say $150 a night, right? We're just not going to spend money on anything more expensive than $150, right? And let's imagine that hotel room was $400. Let's assume that because they were having a meeting at the hotel room of this very wealthy investor. And what this founder did, and he describes it, and I thought this is so fascinating, he used his personal card. And this ex-CEO of Whole Foods noticed that, and he says, "Hey, I'm just curious, why are you using a whole personal card?" It says, because of the policy that says that we employees cannot pay for a hotel that's 150. If it's above 150, I'm using my own money. And that was it. That was the thing that made the guy feel like I could trust you. Like you're putting the company in a very, you're not treating yourself beyond the company. You have a policy you follow. You're not wasteful. I can respect you. And that person went to bet for him. So these are the stories that you hear every single podcast is nobody is coming in. And 2021 was the following. I have one meeting with a VC. I have another meeting with another VC. The second meeting is term sheets, and third is wiring cash. Because there was this pandemonium of cash flowing through the market, and everybody thought they wanted to get a deal, otherwise they'd lose it. This is not today. This is the reality. It's not here. You do not expect it. Anyone who's told you I'm an expert of raising money because they did in 2021, I recommend you to walk away from that person immediately.
Christine, do you have any such story for us? Something that impressed you very much?
I mean, I very much relate to what Alex says. I think it's really all about, getting that, that sense, that trustful feeling of integrity, of, being authentic as a founder. I mean, if I think, about myself, how we started with our fund, this is a bit of personal sharing, but our pitch to our, one of our very, very first pitches, this was long before our fund structure was in place, was at a highly reputed, large, very professional foundation that we at all did not know. We got an introduction. We did not know those people there. They did not know us. So, and they also asked us, I mean, how did you actually come to this stage? And we said, honestly, we invested our private money. We dissolved our pension fund. We are just really in for this. We so believe in this. We also investing our private money in the fund. And we had that pitch, and it was very, very, how should I say, professional. We walked away. We were not sure what the outcome would be. Next day, they were calling us, and they said, we're in as anchor investors. And much later, they told us, we really, really liked, that you're just all in. You're investing your own money. We believe we can trust you. And I think this very much resonates with what you said, Alex. And it's always that feeling of authenticity that you want to also feel in a founder and in the founding team. And I think this is undervalued. If you, you need to work in the long run with those guys or with the founder team. And this is extremely important that those values are aligned.
Yeah, so it's actually,
I love that story. That's an awesome story.
Yeah, it's really nice. It's about being real, actually. Keeping it real and being yourself, and not. And this also somehow connects to not only doing it for the money. So, and then that goes back to impact investing again, right? So having this feeling, and it's kind of really being really holistic about your approach, maybe. Looking at the watch, 7 minutes left. What are the next spaces that where we're going to see the most investments in this year for 2025? We've got one half of the year is gone, another half is coming. Where are we going to see the money flowing?
Yeah, I'll go first. Software.
I mean, why did I even ask you? Yeah, it has to be software.
Now it's now we already see in 2020, the first half of the 2025 was software. It has been the year of software. If you look at big checks where it's primarily going, or government-backed funds that are creating localized jobs, right? Or robotics. Yes, robotics is which is lowering cost savings. Software or job creation for local industries, that's where you're gonna see it. Or businesses that have software-like margins potential, that can happen as well.
Christine,
I mean, I would add when we're talking about the food space, I think AI is going to play continue to play a dominant role. Across all sectors. We just recently, just a couple of days ago, had our investment meeting and we approved a new investment also in the AI space, but it's more in the climate tech space, but also in the food system space, I think AI is really going to be a main driver in various different sectors. I mean, and still, as I said before, I think also the whole bioeconomy cell X space is still very much important, but everything across whatever supply chain optimization in AI, or new whatever how you develop new tastes. So like how do you call it? Like novel food formulations. I think their AI has a huge leverage.
I've also seen that you're doing quite a lot about circular systems, and how did that come in here? I know, like in my book, this was one big finding for me, that we're actually all talking about circularity, but not really working circular. How relevant will circularity be in the following months for the food sector, and where's the money going to go concerning circularity? Can you give us insights on that?
I mean, there are different angles, right, where the money could go, but I think also, the whole food tech space is one of the key levers to accelerate the shift for the circular economy. That could be, for example, in food processing, in whatever shelf life prediction. So I mean, I can give you an example. For example, I don't want to mention names now, but we're looking at a very nice company, actually, from the Netherlands, like very circular. They maybe this reveals too much, but
feel free.
I definitely think the food tech space is really a strong lever. It's not only about food waste minimization, but this you need to look at it in a much broader scale, really from whatever shelf life, as I said, extension to to the whole packaging industry. One of our existing portfolio companies is in a packaging space for reusables in Germany. They're growing actually very quickly. We've done a couple of follow-on investments. They also have a tech-enabled business model that is very much driving the shift towards the circular economy.
Last thought I want to seek, or ideas I want to seek from you guys. Talking about impact investing and returns and money and margin. Do you think at the point that we are now at the moment that we need to define investments in a different way, and maybe also have to take into account different dimensions and develop something such as social coins, that we kind of need a new way of paying back when we receive money? Is this even possible? In my book, I'm talking about planetary capitalism. Do you think that something such as this could be possible in the next years, that we can get there societally? Big closing.
What do you mean? I'm sorry. Like, tell us what you mean.
Seeking investment, we're always looking at facts and figures, how to get to the money. And okay, of course, you said we've got these more soft dimensions like relationships and being real, but in the end, what counts is making the money. That's why we see products from companies that go away from the original idea, because they have to bring the product out there to make the money. And I'm thinking about what I'm thinking about is that we are maybe developing away a bit from the capitalistic idea of investing, and maybe can have something such as social coins. I mean, of course, I think about bitcoins and stuff and new ways of paying off, that there could be a different way companies can give something back, like you said, for example, employment. And that, are we there? Are we ready to develop into this direction? Or Are we still far away?
I'll, I'll go first, and now Christina will finish. Look, I guess I'll say, look, religion is a big part of my life. Spirituality is a big part of my life. I give money to my synagogue when somebody gives money to their church or their mosque, not because they're looking for an investment, a return on investment of a meaningful return on investment in financial. I don't look for my synagogue to give me a 5x return on the donation, right? So that we have a lot of ways of how money is given, and not expecting the return to be financial, right? But I don't call that an investment, a financial investment, right? We're seeing right now investors put money into businesses which are terrible businesses simply for reasons of impact. And they can do that, right? We have seen certain, I'll be very direct, Beyond Meat just raised $100 million from such investment. Right? If somebody looked at them simply as a business, I think they would have very strong doubts why $100 million right now is a good investment to give into Beyond Meat. It just, from a balance sheet, is a very hard thing. But for that investor, it wasn't just a sense of a financial return. They were looking at this as a societal good. So we absolutely can have investors who are making choices on almost of another value, and the governments should be able to support that. The United Kingdom, for example, creates tax breaks for angel investors, right? Where the government eats a part of the investment, and it reflects it on the tax return of the investor, right? So that is a great tool. So to me, there could be another class of startups potentially which create tax breaks for the investor if they're willing to put money into a social good. But I want to be very clear: if you are not if you're looking for pure VC power play investment, and that is your approach, then you have to treat your business like a business, and it has a very expected set of returns. And if you don't match those returns, you will not get investment, and that is the reality. If you, that is, and that's okay, right? And I'll finalize this with this point: is I think so many of the companies in 21 and 2020 came from an impact story. And the science was so early that there were enough assumptions that were not known that justified valuations which made no sense. And there was a potential for returns that maybe made sense. Now we know those assumptions have been tested. They have shown not to work. And therefore, there's a doubt for definitely generalist investors to put money back into those funds, into those companies. And I do not believe that will change. It will not.
Okay. Thank you so much for your thoughts. Christine, you want to add something? I mean, you are an impact investor.
Yeah, very, very interesting what you said, Alex. And in my book back in 2017, I even wrote the chapter. I actually, also we have a chapter
I want a book. Christine, can you send me the book? I want the book.
Yes, of course. I send it to you. Alex, you sent me your address. I send it to you. And it's about, the spiritual dimension of conscious investing.
That. Okay.
That's that so much goes beyond even like a positive environmental or social impact. But to keep it easy for our audience here, I think you're absolutely right, Nadine. So we need to also change our current system, much more towards also the approach of a regenerative capitalistic approach, but that's a stepwise approach. And, we can't from one day to the other shift to the new narrative. So it's a stepwise approach. I think impact investing is super helpful on that way. I think capital alone, as you say, right, can't be the North Star. We need a different blended metric. But we always say, also from a business perspective, for us, that's the beauty, that is what makes me, so passionate about what I'm doing, and also so confident, that's the right thing to do, the right investment to do, that we always say increased impact is also increased financial valuation. And that automatically, drives that shift towards a regenerative economy, increased positive impact, maybe if we are very specific. But so I mean, that's a whole topic, I think, where like a whole panel could be super interesting. But we need to close now.
Yeah, but you leave me really optimistic. I'm so grateful for all your insights and your thoughts. Thank you so much for being here. Thank you guys out there for listening. And actually next month, we're going to talk about the circular economy. Maybe you're going to join again, and have a nice evening, and good luck for your next pitch and pass.